Happy rate roulette. After a great anticipation and divergent bets on red 25 or black 50, trading ahead of the Fed's rate cut hasn't proved this edgy in a generation. We'll go into a deeper dive soon as part of this Fed Roulette special on behalf of the Foundation for the Study of Cycles with your host, Ron William, FSC Development Director. Key focus points for this session, 3 parts. Fed Roulette, the high stakes, divergent bets, and generational surprise in terms of what happened and the data that supports that. Conflicting signals, soft versus hard landing in terms of the economic growth, potential slowdown, and recessionary concerns. And then lastly, for section 1, this ongoing view on both equities and US 10-year yield, which are reflecting those conflicting skills. We'll do a follow-up on each of those in section 2 and then the final 3. Now, looking as a follow-up to that, equities, triple whammy headwinds remain. Remember, it's momentum, rotation fragility, and cycle risk. Momentum will look at the short-term tactical view for the next few weeks. In addition to that strategic bull trap, looking for a potential top into 2025, back into 2007 and 8. Rotation fragility, key focus will be on NVIDIA with the question, is this a potential fall in grace? And then lastly, the cycles model and the confluence that supports it, particularly as we go into the second half of September, negative seasonality into October, and the US elections ahead, with heightening geopolitical risks that is likely to create a wild card factor for many market and world watchers. And then to close, key cross-asset inflection point, looking at US 10-year yield, inflation and commodities, and then finally US dollar risk under 100 if we look at the dollar index. Each of these charts are looking at price and time inflection points, some featuring FSC cycle model and other timing measures. And for further resources, do know, first and foremost, the FSC blog, as well as support media interviews such as CNBC and Real Vision that will follow in the links. Rate roulette, as we can see here with the opening cartoon, putting all bets on the Fed cut, which has been a long macro theme for well over 6 to 12 months now, dubbed the behavioral inflection point by myself, as part of this ongoing excessive optimism in the economy, markets, but also the central bank themselves. So after the great anticipation, divergent bets on red 25 or black 50, trading ahead of the Fed's rate cut hasn't proved this edgy in a generation. And that is quite literally what the data is now demonstrating. According to local industry analysis, the realized surprise of Fed fund rates versus market pricing was the largest in 15 years. So certainly this does present a powerful cross-asset price and time opportunity that all FSC members should take note of. So let's look at the Fed pivot event risk. How does history rhyme, and what can we learn from the past as a potential navigation for the future ahead? Record widest spread of the 2-year yield versus Fed fund rates, which is what we're seeing right now on the main chart, predicts the aggressive tightening that we've already seen, also the 50 basis points that happened, and further catch up ahead, another 50 basis points likely before year end. However, it's also a historical precursor to event risk, notably at late cycles. So we can see here this record extreme in 40 years, unprecedented, giving that red signal that the Fed themselves will be watching, but also it's likely feedback and warning from the market to everyone else as to a potential historical rhyme last seen, as you can see they're labeled on the chart: 2020 COVID shock, 2008 GFC, 2001 tech media telecom bubble, 97 LTCM, 1990-92 event risk, including the ERM, and then 87, the well-known crash. So ultimately, this is a make or break time for the soft, hard landing consensus, weighed by negative macro surprises, but also juxtaposed by conflicting signals across both benchmark measures of equities and yields. You can just see there in the chart in the bottom right, the big divergence between equities at top in green and US 10-year yields in red at the bottom, essentially one voting for soft landing, good times ahead, and the other in for potential warning signals as to risks that may prevail. So let's look at those conflicting signals in a deeper dive focus. S&P 500 as a case in point. This has been well tracked in our FSC vlogs, so we'll continue, especially as both the theme and the timing closes in on this potential turning point. So the short-term tactical time pattern remains. What's changed? We've had an extended rally to the upside, which has surprised, but it does seem fragile in terms of price momentum, but also internal breadth. We still have some rotation, but not that broad and sustainable. Now let's just focus on the price and time pattern. We have a potential wave 5 pattern still in the making. There are variations of that according to many of you that will be aware of the edit wave model. I haven't included it on this occasion just to keep an open view and let the market decide ultimately the pattern that it wants to take. But what is important is to highlight the fact that we are still making a marginal all-time high on S&P 500. That's on face value positive, but there's a non-confirmation with other related indices such as the NASDAQ and the Russell 2000, Big Tech, and Main Street. That's one point to highlight. Marginal all-time high, which is not confirmed by the other major indices. Second point is that we have a price exhaustion signal just posted recently, another red 13 on the DeMark momentum indicator. Some of you would have watched the work of Tom DeMark on behalf of the Foundation for the Study of Cycles some time ago, so do look into our YouTube archive for that. This is the second exhaustion signal that took place. The last one was in late August. This is right here and now, a day before recording, and there is a risk level at 58.50 for those of you who are looking for potential price inflection points. Now, from the timing perspective, I want you to focus your eyes on the symbology at the price line top side, as well as the boxes highlighted in the lower window titled theme. And you can see here that we've had seasonality patterns based on natural cycles. Specifically, we've previously had things like the solar lunar activity, and particularly the eclipse of April last year, which did create some volatility and a reversal thereafter. We covered that on behalf of the FSC. Please look back to the April video for more in depth in terms of the how mechanics, but then ultimately the setup. And now we have a mix of the two, lunar and solar eclipse, one past, the second to follow. As soon as you watch this video, pay attention to the likely inflection in sentiment as we're at these extremes. Now, looking at the strategic long-term view, S&P 500 remains in what looks like a potential bull trap scenario akin to 2007, 08, when we had the top and the GFC to follow. Remember, that was a three-staged corrective pattern: fall, rally, head fake as part of the rally, and then the rest of the fall. Now, what's interesting about that is, A, it wasn't an overnight event. It was a process, 3 stages, as highlighted on the top chart. But the other point is there was a Fed pivot that took place during that transitionary top base. Fed pivot 18 September 2007. So a potential historical echo that is being heard throughout the timeline from past to present. Now, the bull trap scenario is essentially excessive sentiment, leveraged positioning, leading to a blind sight moment where market forces are forced to reverse amidst elevated volatility, and that's what creates the bull trap and follow-up squeeze to the lower side. Keep in mind on the lower panel, market timing measures that remain bearish. FSC model on the long-term weekly, which is still looking for that potential top into the new year of 2025, akin to what we saw between 2007 2008. That was part of a long, drawn-out topping process, not an event. And then side next to it, to the right, is looking at solar activity based on sunspot extremes. And whenever you get a high excessive read, that typically leads to strong optimism that then peaks out and leads to a transition and a bear cycle to follow. So that is already showing the excessiveness. You can see there, gray line into this current period, and then a future projection looking at the various forecasts into the new year and thereafter, 2025, 26, and thereafter, as part of a multi-year transition process. So look at the price pattern analog, potential head fake signal that leads to a topping process, which is also confirmed by the long-term timing models, both FSC and external sentiment data based on solar activity. Now let's look at the market internals. We've just covered momentum. Now we're looking at rotation in terms of market internals and the likely fragility that remains. Here, I'm just going to focus on NVIDIA, which is already serving as the tech poster child. It drove more than 30% of the S&P 500 in the first half, but has now triggered a sharp correction that deleted a record $279 billion of market value. Now, from a tactical perspective, look at the chart on the left with the price regression overlays and corresponding cycles. What it shows is a potential mean reversion sub $100 into $90 near the long-term 200-day trend, figure 1 and 2. This also equates to a 30% peak to trough drawdown. We've already been there and done that in recent times and could likely do it again. Only a sustained close under 90 will unlock further downside risk in line with the FSC's bearish timing signal. If you look at the long-term measures just here on the chart, bottom right, into year end, which at the very least highlights more volatility and a likely top in place on NVIDIA, as well as Microsoft, which is also one of the stronghold tech names. So certainly the generals in the field are starting to get tired and potentially walk back. We are seeing some rotation from the broader soldier formations, if we play on that military stock market metaphor. And ultimately, at some point in time, this may give as part of the second headwind on rotation fragility. Remember, momentum, rotation, and now we'll close on a cycle, which I just previously covered. Now looks at the cross-asset inflection point. Now, remember, there was a conflict of signals between equities and treasuries, suggesting either soft landing or hard landing. So we just covered the equity piece, looking at the ongoing triple whammy headwinds, momentum, rotation, and cycles. Now we're going to look at the other side of the equation in terms of some of the warning signs already there in terms of the actual chart action on treasuries, looking at the yield 10 years. Now here we see a likely inflection point between 3.5 and 3.3%, key support zone on US 10-year yields. Expect a long-term trend in the 10-year to resume higher for longer into the 5% threshold. Also keep in mind, it's not just one chart. You can look for further support on inflation expectations, which signal a potential inflection point. The chart at the bottom, there you can see the resistance turning to support. And ultimately think 1970s. This has been a theme and an historical analog that I've shared with FSC members before. And you can see the zoom in chart showing a potential completion of the low of inflation. This is looking at US CPI in blue here and now versus 1970s, and more specifically 1976. Now, as this pattern, which has so far been matching for the past decade or so, if and when it continues, then ultimately we could get a major low and inflection point in inflation expectations and inflation itself, and then a takeoff thereafter, likely in the next 6 to 12 months, after a potential growth slowdown, equity or risk market unwind, which ultimately could lead to stagflation, where we get a slowdown in growth, increase in unemployment, and certainly a cost of living situation that will likely be positive for commodities. And I do want to allude here to recent work that's been done by FSC board member Lars von Thienen, the host of our Cycles TV, suggesting that there could be a low in oil and copper potentially in the making. So watch out for early cyclical positive plays in commodities, oil and copper being a case in point, according to chart work that I've done and also cycle work from my colleague Lars. And to close, US dollar, another cross-asset inflection point in the making, but this time down, not up. We can see the dollar's decade-long trend under risk if it breaks below the psychological level of 100. This is already being led, in terms of dollar weakness, is already being led by G10 FX outliers. Think of Japanese yen as part of that carry trade unwind, but also in Europe, Swedish krona, and in the Americas, Canada. There are other currencies that I can share with the FSC cycle model overlay, along with other tactical measures that I use. I can do that in the future, but for now, do know that the dollar block and the dollar index is looking like it will weaken further if it breaks below 100. This is further weighed by growth slowdown, falling rate differentials, especially after the Fed cut 50 basis points past and another 50 to follow, but also notable de-dollarization trends, slow but notable, and that will continue to weigh. Now, if you look at the chart on the top left, you can see that support level at 100, that red line that I've just annotated for you. We break below that, we head down to 95 and maybe lower. That is a corrective pattern after a long-term impulsive wave trend. So that's the part on dollar risk under 100. And then the chart top right, figure 2A, that shows a relative comparison of G10 currencies in terms of liquidity positioning and valuation. And you can see here the dollar is overvalued and overstretched in positioning momentum terms. So that's a sign of vulnerability. And then versus the opposite quadrant, you can see they're undervalued and oversold, yen, Swedish krona, and Canadian dollar, as I just highlighted there in the commentary. And then just to close, keep in mind that the cycle model is weighing. The signal is not clear, but on the long term, it does at least suggest elevated volatility as well into year end and the new year. And for those of you wondering what happens if we get elevated volatility, isn't that a positive for the dollar in terms of safe haven flows? The answer is yes, sometimes, but not always. Behavioral sentiment like this, where you get a potential topping process and a bearish corrective pattern, will likely neutralize what is called the dollar smile, whereby renewed safe haven flows during periods of volatility or uncertainty is dollar positive. That may not work on this occasion, and it could be an exception to the rule based on the weight of the price and time measures that I've just shared with you. So just to close, key insights for this installment of FSC vlog for the month of October. Rate roulette, high stakes, divergent bets, and generational surprise, conflicting signals, soft and hard landing, where we focused on equities versus US 10-year yield. We then did a deep dive on both. And on the US equity side, we focused on the triple whammy headwinds, momentum, rotation, fragility, and timing. And then on key cross-asset inflection point, we looked at the other side of the equation in terms of the warning signals on US 10-year yield, in addition to supportive evidence on inflation and commodities, with a side note on commodity markets such as oil and copper. And then to close, US dollar, another major cross-asset, risk under 100. More to follow on the currency side to give you a mix of different portfolio diversification opportunities here at the FSC. That's it from myself, Ron William, Global Cross-Asset Tactical Strategist and FSC Development Director. Please feel free to stay in touch via our FSC communication, email on the screen and on our website, as well as social channels across the board. Thank you very much. Always an honor and a pleasure. Speak soon.